Well, hi everyone, Sean Humphries here. Welcome to All Things Retirement. In this installment, we're going to talk about a really exciting topic, mutual fund classifications. Okay, hold on, don't leave yet. If you have mutual funds in your portfolio, then you want to take in this video because understanding classifications will help you understand the costs that you're incurring and to be able to make use of those fees and more effectively for your particular situation. Now, if you're new to this channel, make sure that you hit the subscribe button. We're posting content all the time, so if you don't want to miss the latest content on quite literally all things retirement, make sure you subscribe. Now, when we take a look at mutual fund classifications, there's a few things that we need to be mindful of, and really the first part is knowledge on cost and service. So what are the types of costs on mutual funds? That's the first thing. What services are you getting for the costs that you're incurring? And I'll just stop there for a minute. A lot of people know that there's costs being incurred. They may have gotten a prospectus or some sort of disclosure information when they bought the investment, but that was a while ago. It's not top of mind, and you don't really think about it too much. And when you look at your statement, as long as you've made some money, you're probably okay. But you need to understand what the costs are and the services that you're getting for those costs. And we'll cover that off today. And then once you understand that material, what's right for your situation? How do you figure out what particular approach is most appropriate for how you manage your portfolio? So we're going to talk about the fees and costs within the mutual funds. Most of those costs, more often than not, are embedded costs. We'll go through it. Now, when it comes to investing, the lowest cost approach to investing would be through stock and bond trading using discount brokerage accounts. So if you had a discount brokerage account or service, most of the large charter banks have them, and so you can open up a discount brokerage account. There's no advice attached to those accounts, and they'll allow you to trade in securities, to buy and sell. You control the account, and typically those costs are pretty low. So trading costs, when you buy and sell, that's when you incur the cost. The cost goes up with the frequency of trading. So obviously, the more trading you do through the year, the more costs that you might incur to manage your portfolio. Discount brokerage platforms do presume more knowledge than the average investor. So we're making the assumption when you're doing some trades that there's a methodology or a process behind that trade. And there are time commitments, so it takes a little more time to manage your own portfolio. But if you're trying to find the lowest cost approach to managing your portfolio, discount brokerage account, do your own buying and selling, and typically the trading costs to buy or sell would be on either side of the trade, might be anywhere from $3.50 to $7 a trade, depending on what you're trading and your frequency of trading. That gives you a bit of a range. Okay, so that's the first approach, and for many clients, it's not a real fit for them. So many people don't have the time to do it. They may not have the expertise. They don't maybe have the interest to do it. But this is one approach you can take to managing your portfolio. Now, when is the lowest cost investing not a fit, right? So I've alluded to this already. So we all want to save money, right? You don't want to pay more than we need to on the cost of investing, that's for sure. But if you start checking the boxes on these points, then that's a clue that you may need to get some advice or assistance with your portfolio. So it could be a lack of time, a lack of expertise or experience, which I think is a prerequisite to be successful with your portfolio, lack of interest. I've seen many people have interest for a period of time, they jump on a bandwagon, and then all of a sudden life gets busy and they lose interest. That's not great for your portfolio. Risk adverse, okay, so the more risk adverse someone is, the more likely that going with a low-cost discount brokerage platform is appropriate for them. If you value coaching and expertise, there is a segment of the investment population that goes, I'm interested, I like learning about information in the area, but I know that I'm not necessarily going to be objective about my own finances, and I value coaching and expertise to help me make the right decisions when emotions are heightened or life circumstances keep me from making the high probability decisions. So if you feel it's hard for you to be objective about your own finances, then coaching and going with a low-cost option may not be the right approach to take. Now, when it comes to portfolios, one of the ways that investors leverage off the expertise of others is through the purchase of mutual funds. Now, we have other content that goes into mutual funds in more detail, But essentially, a mutual fund is usually a trust account. In that trust account, you've got thousands of people putting money into the account. There's a portfolio manager that's hired, and that portfolio manager will begin investing money under certain mandates for the portfolio. When you go down this path, one of the most common classification of units is A-class units. And with A-class units, you typically have three components to this unit classification. So over here, you got the PM, the portfolio manager, and they'll charge a fee for their services. For the purposes of our discussion today, we might use a number of anywhere from 85 basis points to 1.25% per year. We've got a $100,000 portfolio. Let's say it averages 1%, so $1,000 a year for their expertise. What's a PM do? They're buying and selling stocks, they're doing research, they're doing all the portfolio management strategies that you would think of, trying to reduce risk as much as possible, doing site visits, let's say to companies they're buying, analyzing the balance sheets of the company, trading the portfolio to make sure it responds to either opportunities in the market or to become more defensive if they think there's more risks in the market. You then have expenses, and all of these investment trusts have expenses. It's not unique to A-class units. That could be prospectus filing costs, trading costs, safe custody costs of the securities they're holding. Those would be some examples. And if you used a expense cost of around 25 basis points, quarter point a year, $250 for a $100,000 portfolio, that would be a basic starting point. And then over here, you've got service. Now, service in an A-class is embedded in the investment. So you're paying a portfolio manager, you've got expenses in the portfolio, and then the final piece, which might be 1% to 50 basis points, 0.5% a year, depending on the portfolio, is service. Typically the bank advisor, your financial advisor, someone who's giving you service and advice on building the portfolio, maybe doing the administration, linking your portfolio to your financial planning, and so their compensation is embedded into this overall expense, often referred to as the management expense ratio on the portfolio. It's not right or wrong, it's just one approach, and in fact this is probably one of the most common approaches in the industry, is having this combination of PM costs, portfolio manager, expenses, and then service costs on the portfolio. So when you see A-class units, which is a very common classification, what you know is you're incurring likely some service costs, and you've got an advisor that should be delivering service on your portfolio. And then you're delegating the stock and bond decisions, as an example, if it's a stock or bond portfolio, to the portfolio manager. Another expense model is F-class units, and it's quickly becoming a very common classification. The big difference between A-class, which we just talked about, and F-class is that F-class units strip out all of the service and advice costs from the investment itself. So when you buy an F-class unit, you're incurring the portfolio manager costs, as an example, and there'll still be expenses in the portfolio. So in my previous example, you could have a 1% cost here, and let's say, just for example purposes, 1% cost for service, 25 basis points for expenses. So the total cost on that portfolio, let's say, is 2.25%. If we go to F-class, you'd have the 1% for the portfolio manager, you'd have the 25 basis points for the expenses, but then all the service costs are stripped out of that portfolio, and that isn't there anymore. So you're just buying the portfolio management expertise, but you're not embedding the service and advice cost into this investment. And I'll talk about where F-class units principally get utilized when building a portfolio. Okay. Now there's a lot of other classification of units. The most important takeaway here is when you look at the different classifications, they'll typically denote various things. So number one, it could be slightly different fee structures. It could be like this, where you've got an F-class versus A-class, where they strip out advisor compensation. And the most important thing is to begin asking questions of your advisor or financial institution about the different classifications and what you're paying for within those classifications. Now, what I'm showing you here is a model that often will use F-class investments. So I'm going to walk you through this model and share with you how it works. So this, again, cost of advice discussion, this is the chart that you just saw. One of the issues when you go through this classification discussion, we've got the A class, which has compensation for service and advice embedded in the actual investment itself. And then you have F class, where they've stripped out the service and advice cost, and you're just paying for the PM and then the expenses of the portfolio. Now, the backstory to that is that for many investors, there's a concern often that when an advisor or a portfolio manager is getting a service and advice fee that's embedded inside an investment product, at the very least, it creates a concern around a potential conflict of interest. And we want to make sure that in the investment advice business, we'll get away from that as much as possible. Clients should never wonder, are you making the recommendation because there's this service fee embedded in the investment? Or are there other investments that might be better, but you're not recommending them because you're not getting compensated to serve my account? So when it comes to cost of advice, what you see here is this chart. And on this side of the chart, you've got various potential investments. Okay, so we'll talk about that in a second. And then over here, you've got advice and implementation and service and administration down here on this chart. Now, the reason I show this chart to you is that this would be an environment where if I have this mutual fund category here, this is where the F-class investments would be used. This would be what's called a discretionary account sometimes, or a fee-based account, where the advisor is not paid any compensation from the investment. So in other words, any investments that show up over here, whatever costs are being incurred, whether there's mutual funds or stocks or bonds or ETFs, whatever is in the portfolio, there is no compensation going back to the advisor out of the investments. So the advisor is agnostic as it relates to placing certain investments in the portfolio to generate revenue. So what it should be is what investments are most appropriate for you as a client to help you meet your objectives and to be consistent with that risk return temperament that you have. Every client's a little bit different on that continuum. Over here, under advice, that's what the client's paying for. So it could be the development of strategy, so doing financial planning, forecasting, coming up with strategy around what the client needs to get as a return to achieve their goals. That drives the mix of investments or securities in the portfolio. And then once that mix is put together, then assisting the client with implementation, which means moving them across to the brokerage platform that the advisor might have and helping them acquire various investments. They'll then monitor the portfolio. They'll provide coaching and encouragement and accountability along the way, education if needed, and of course service and administration. So if I look even at my team, I've got 3 staff that do nothing but service and administration. So as I'm working with clients in their portfolios, we get paid a fee by the client directly. It gets debited from their account, and we receive no compensation for the investments that are placed in the portfolio. So that follows what's called a fiduciary model. So there's a clear separation between the service and advice and the compensation the advisor gets for that, and any costs on the security side. This is where often the F-class investment units will be utilized. Because over here, we've stripped out all advisor compensation. The client's not paying double. They're not paying a fee here for our advice and then paying a advice fee on the investments over here. So what ends up happening is the cost of the investment portfolio overall is just going to be a function of ETFs in the portfolio, stocks and bonds in the portfolio, or mutual funds in the portfolio, and whatever those investment mix decisions are, that's what drives the final cost. If I had a client that wanted to go low cost as possible, we might just have individual securities or ETFs, low cost ETFs. I might have some biases around the value of active management through pooled accounts or mutual funds in certain situations. But at the end of the day, if the client was really fixated on cost, although I may not completely agree in certain circumstances that cost is the only thing that matters, because in the investment business, I truly do believe that extra costs for certain investment management services are not superfluous, costs that are just drag your return. They're there for a reason. But in any event, the client can drive that cost down and yet still access our service and advice. When the client's saying, I want to get the strategy, the implementation, the monitoring, the coaching, the education, and the service, but I want to get it done for the lowest cost possible. Other clients would go, no, I understand cost differences, and I might pay a little extra for downside risk reduction or mitigation on the portfolio. Okay, so hopefully that's helpful. F-class investments that strip out service and advice compensation, are typically used in this fee-based model where there's a clear separation between the cost the client's incurring for service and advice and the cost that they're incurring on the portfolio. And this moves the discussion a little bit further. It's an illustration of what investment counselors or advisors typically do. The Quest Trade commercials and some of the commercials that talk about costs never talk about the reality that the people that are successful typically with their finances, with the building of wealth, work with advisors. They work with accountants, with lawyers, and wealth planning investment managers. That's just a reality. And the reason for that is that those clients understand that investing is not just about investing. Investing is about an overall wealth plan and a coaching and accountability relationship to help the client make the high probability decisions through their life. And so, when I'm working with clients as an advisor, yes, we're putting together the portfolio and the recommendations. We are providing wealth planning, which means looking at the estate, tax, retirement, succession planning in the business, if any. And then we're also looking at investment management. So once we've got the portfolio designed, the ongoing management of that portfolio over time. Those are really critical things. But in my mind, along the way, it's the later in life planning, transition career planning, retirement planning, integrating pensions and government benefits, and understanding how we can fund cash flow and living expenses, particularly when someone stops working for their career. It could be insurance planning, making sure that risks are dealt with effectively. There could be family planning in terms of caregiving and educational costs and different issues that come up over time, and then estate planning through the wills, powers of attorney, business succession, beneficiary designations. So, the mantra that I often say to clients is when life changes, money changes. When money changes, life changes. And so in the midst of that change, that sometimes bad decisions get made, and that's the advisor in that moment, whether it's economic volatility, market volatility, and life volatility, that's when people make the critical mistakes. So whether you are engaging with an advisor through A-class investments and their cost is embedded, or whether it's an F-class, not an A-class, where there's a clear separation between service and advice costs and investment costs, the most important thing is to try to find, first of all, do I value that coaching relationship? Do I need that coaching relationship? And then I think in my estimation, when I look at the different classifications, like the F-class classification is superior because that model gets away from that discussion around, are you getting compensation as advisor from the investments? No, great. Then as one more reason that I believe that you truly do have my interests at heart. So I do believe coaching is the answer. It's the secret sauce. I alluded to the fact that there's so many commercials that just break it down to, cost. That's the only thing that matters. And study after study confirms that that's just not true. We're human beings. Human nature being what it is can get in the way of success sometimes when it comes to finances. So that coaching relationship, I think, is critical. So again, if you want to get future content systematically, make sure you hit the subscribe button for this YouTube channel. And make sure that if you want more information about our coaching services, our various investment planning services, and just great information, in the description under this video, you'll see different links to various service offerings that we have. Anyway, wishing you all the best in your retirement journey and your journey to make good, sound investment decisions. You take care. Bye-bye.